Hello everyone, welcome back to our channel. Today we have an exciting topic to dive into.
All right, let's get right into it. In this explainer, we are going to tackle one of the most frustrating things in trading. You know what I'm talking about. It's when your charts are giving you completely opposite signals.
Oh yeah, this is the classic. This is the situation that drives traders absolutely crazy. You've done your homework, right? You see this perfect setup on the daily chart. It's telling you to go long, but then you zoom in to the 15-minute chart and it's just screaming sell at you. It's totally paralyzing, isn't it? You know, this conflict, it's not just confusing. It can be downright dangerous for your account. It leads to all that hesitation, that second guessing, and more often than not, it leads to making the wrong move at the worst possible time. You either miss a fantastic trade or you jump headfirst into a bad one. But what if I told you there's a really clear, super straightforward rule that just cuts right through all that noise? A principle that can settle this fight between your charts once and for all. Well, the solution is something we call the hierarchy of strength. This is the core concept that's going to bring some order to your analysis and honestly give you the confidence you need to act when those signals start to clash.
And here it is. This is the big one. If you're going to write anything down, write this down, memorize it. The higher the time frame, the stronger the level. This one sentence is going to be your North Star.
So, here's the crucial point. Not all signals are created equal. A signal you see on a daily or a weekly chart carries way more weight. I mean, significantly more than a little blip on a 5 or 15-minute chart. Let's dig into why that is. Now, this right here is such a great way to think about it. Imagine a daily support level. Think of it like the concrete foundation of a skyscraper. It represents the conviction of the big money, the institutions, built up over weeks, maybe even months. Now, compare that to a 15-minute resistance level. You know what that is? It's just a speed bump in the road. It's intraday noise. So, which one do you think is going to win in a head-on collision? Yeah, it's no contest. Okay, knowing the theory is one thing, but let's make it practical. Let's make it actionable. Here is a simple 3-step plan you can use every single time you find yourself in this situation. Let's break this down. Step 1 is so important. Always zoom out for context first. You have to anchor your analysis in the big picture. What's the daily or the weekly trend doing? Step 2, trust that anchor. That higher time frame level, that's your foundation we just talked about. Don't let those little intraday speed bumps scare you away. And then step 3, trade with that foundation. See that minor resistance not as a brick wall, but as a hurdle that's likely to get cleared in the direction of the main trend. Let's boil that down even further. It's this simple. The daily chart tells you which way the river is flowing. The 15-minute chart, it just helps you find a good spot to jump in your canoe. Direction from the big picture, timing from the small one. That's it. So we know the foundation is stronger than the speed bump. We've established that. But what actually happens when they collide on the chart? Let's look at the two most likely ways this plays out when that strong daily support runs up against that weak 15-minute resistance.
Generally, one of two scenarios is going to unfold. And if you understand these, you can start to anticipate the market's next move instead of just reacting to it, which is a total game changer.
Okay, the first and probably the most common outcome is what's called absorption. The price just hits that 15-minute resistance and kind of stalls. It might chop around a little bit, soaking up all the sell orders like a sponge. But because that demand from the daily chart is so much stronger, it eventually just punches right through it. Now, the second outcome is a little sneakier. It's the fakeout. And man, this is a perfect illustration of why trusting that higher time frame is so important. This move is basically a trap designed to catch short-term traders on the wrong side. So here's how the trap is set. The price pushes up towards that little speed bump, and then just for a moment, it dips. To the untrained eye, this looks weak. It looks like, oh, the resistance is holding. This little dip is bait. It's designed to trick sellers into thinking the trend is reversing. They jump in short, they're feeling pretty smart. Have you ever fallen for that? I think we all have at some point. And then, bam, the trap springs. The price uses that deep pool of buyers down at the daily support level, the real foundation, as a launch pad, and it just rockets upward, leaving all of those trapped sellers in the dust. So let's just do a quick recap of the really crucial points here. First, always respect the hierarchy. The higher time frame is king. Second, use your lower time frame strategically for timing an entry, not for deciding which way to go. And finally, learn to spot the two likely scenarios, the simple absorption and that more dangerous one, the fake. The next time you open up your charts, I want you to ask yourself this one question.
By focusing on the higher time frames first, you can really learn to see the market's true structure, its foundation, and just ignore all that distracting noise that traps so many other traders.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.